Okay, great. Yeah, as I was saying, well, the name of my presentation is 6 Key Questions When You're Buying a Business, and I want to walk through the 6 main areas of any acquisition that really impact from a legal standpoint, or what I, as a legal practitioner, will be helping you with most in your acquisition journey. So when someone is referred to me and they're especially a buyer looking to buy a company, these are the main questions that I ask them in our first like intake call after they've hired me, or even before they've hired me. Just these are the questions that I would like to know about their deal to help me know best how to help them and point them in the right direction as they're moving forward with their deal. So before we get into that, just a little bit about me. As I said, my name is John Wiest. I've been an attorney for over 10 years now, and I'm actually located in Salt Lake City, Utah. I was born and raised here, went to undergrad here in Utah, and then went to Harvard for law school. And right after I graduated, I came back to Utah, where I had an opportunity to work at a large international law firm that had a Salt Lake office. The first firm I worked at was called Dorsey and Whitney, and then later I moved to an even larger, one of the largest firms in the world, called Greenberg Traurig. And I did M&A at those firms and worked there for the first 6 years of my career. And then a little over 4 years ago, I decided that I wanted to work for myself, and I was tired of being just kind of one cog in a gigantic machine. So I decided to start my own practice, and it's been a wonderful journey. I really love what I do, and I love working for myself. And it's one thing that I think it helps me when I'm working with my clients who are looking to, either they already are small business owners or they're looking to acquire a business. I think I have a little bit of an understanding of what it's like to run a business for oneself, and it's really fun for me to do. So I've been doing this on my own for over 4 years now, and I've helped a number of acquirer clients. I've been working for acquirer for about 1.5 years, maybe a little bit more. And I really enjoy working with folks that come to me from acquirer. They're usually very well prepared for what the journey that they're embarking on, and I love helping them get to closing and the acquisition of their company. So, okay, and also I wanted to preface a couple of things. So I'm working from my home office today, and my cat is currently sleeping on the cat tower next to me. He may make an appearance at some point in the so please don't be alarmed. And so that's just one note before we hop into it. Okay, so before we get to the 6 questions, there's some typical stages of when you're when you're buying a business, and I've kind of broken them out here. And the first one is what I think a lot of you on the call may be in at this point, where you're in the searching phase, the pre-diligence phase, where you've decided you want to buy a business and you're just looking for the right one. So you're looking around, and an acquirer is helping you get set up for that, and you're looking at various businesses. When you find one that you're interested in, then you will submit a letter of intent to the seller, and you will go through that process. That will have the basic terms of your agreement, how much you're, what you're offering, what you're buying, and some other typical provisions like confidentiality and seller transition services, etc. Once you enter into a letter of intent where you and the seller are agreed, like, hey, these are the basic terms of our agreement, and we're going to move forward under this based on these terms, you'll sign the letter of intent, and you'll have a period of exclusivity where the seller has said, hey, I'm not going to shop this company to anybody else for some period of time, 45 days, 90 days, whatever it is. And they will give you an opportunity to do your due diligence, where you get to look at their books, you get to request documentation from them about their company. And so some of you may already be in that phase. Maybe you're in the letter of intent phase. But at the same time that you're doing your due diligence, well, I like to say that after you sign a letter of intent, you're really doing 3 things at once. It's a very busy time for a buyer. You're doing your due diligence, which involves looking at contracts, looking at financials, and kicking the tires of the company, making sure you actually want to buy it. Then you're also drafting the purchase agreement, which is one of the big things that I help you with as your attorney, is helping you draft the purchase agreement and negotiate it with the seller and the seller's attorney, and make sure that if you have a bank involved, that the bank is okay with it, and get to a final what a letter of intent usually will call a definitive agreement. And then also at the same time, if you are using getting a loan or something else to finance the deal, if you're not doing an all cash deal, you are trying to get your financing lined up and working with banks. And that's also a very can be an intense process. So due diligence, purchase agreement, and financing are all really happening at the same time after you sign a letter of intent. And then if all goes well, you get to the closing date where everybody signs a whole bunch of papers, and you now own a business and you're off to the races. So like I said, I mostly am helping you with the purchase agreement, and we'll talk a little bit in more detail about that. Okay, so if you come to me and you're like, hey, John, and then the next question comes up, you're like, hey, when should I talk to a lawyer? When should I engage a lawyer? I am happy to help clients either before they sign an LOI or after they sign an LOI. Some folks, and Acquire does a very good job of helping you guys with your letter of intent. And so I don't get a lot of people from Acquire who come to me before they have signed a letter of intent. But other clients I have, maybe they don't have as many advisors, and they want a little bit of help before they sign a letter of intent, and I'm happy to talk to them at that point. But I would say the majority of my clients engage me after they've signed a letter of intent. Some of them even want to wait a little bit longer until they've gotten further with their bank and they've gotten a commitment letter from their bank, and that's a little bit more certain that the deal's going to go through. They're like, hey, now I'm pretty sure that the bank is going to lend me a bunch of money. And so they may wait to hire an attorney until that point, and that's all fine. I'm happy to help come in at any of those stages. If you come to me and you are looking to hire an attorney, we will have a call. I'll ask you several, the questions that we're going to talk about on this presentation. And for me to help you, we need to sign an engagement letter, which will set out in some detail the scope of my services, the things that I'm going to do for you, and then the fee that I will get paid, how we'll get paid, and we'll have some other language in there about our relationship as attorney and client. And once we've signed an engagement letter and I've received a retainer up front, then I'm your lawyer. We have an attorney-client relationship, which imposes on me several ethical requirements. It makes all of our communications between just the two of us privileged, and I'm on your side. I'm there. My job is to help you achieve the goal that you want to achieve in the best way and the way that is best for you, as long as it's legal. So I also strongly advise all of my clients to have financial and/or tax advisors. I know enough about. I'm not a CPA. I don't do Q of E reports or anything like that. I strongly recommend that you have somebody help you with those things. And then I know enough about tax law to be dangerous and know when to refer you to a tax specialist. So if your deal, and this doesn't happen in every deal, but some deals have kind of some complicated tax issues that you definitely want a tax specialist to help you with those things. And I'm happy to make those referrals, and I'm sure Acquire has folks that they can recommend to you as well. Okay, so on our first intake call, when I'm trying to learn about your deal and how to help you, I'm going to ask you these 6 questions. The first one, and this is really the threshold one, we can't go any further until we've answered the question of whether you're doing a stock or an asset purchase. Then I'm going to ask you some questions about who are the buyer and the seller in the deal, the business entities or people involved. We'll talk about real property. Most folks lease, some want to buy, but we'll discuss that. And then I'll ask you about your financing. Is it a cash offer or a cash deal? Are you using a bank? Because that makes a big difference in kind of how we move forward and the speed at which we get to closing. And then we'll also talk about net working capital. So I'm going to probably spend more time in this presentation talking about stock or asset purchase, and then net working capital, kind of the first and the last ones. But we'll see as we get into it. Okay, so first question is whether you're doing a stock or an asset purchase. And many of you may already know the difference between them, and some folks don't, and that's totally okay. Many clients come to me and they have a letter of intent that either says they're going to do one or the other, or that hasn't been decided yet, and that's fine. I'm happy to help them understand the difference. So there are pros and cons to both, and I see both all the time. So it's not like one is inherently better than the other. There are good reasons to do both or either of them, and then there are some drawbacks to either of them. So the difference between them is when you're looking is I kind of like to use an analogy to help explain the difference between a stock and an asset purchase. It's kind of the difference between like buying an actual, like imagine that you're trying to buy a store and it's like got a storefront, it's an actual building, and with the name of the store out front, and people come inside and they look at things and they buy things at a cash register, and there's back rooms, offices, maybe some storage space. So the difference, if you were to do a stock purchase, it would be like you were buying that building itself and everything inside of it. You're buying the whole kit, kat, and caboodle, okay? Whereas if you are if you're doing an asset purchase, you're doing something legally a little bit different, where it's like you were building a brand new building, a new store right next door. Maybe it's even identical to the old store, but it doesn't have anything in it. And then what you're actually buying is you're buying all the stuff inside of the old store, and including the name and the logo out front, and you're moving all of that stuff out of the old building into the brand new building. And so it's right next door, and maybe the old building is torn down or something like that. So let me see. Okay, whoops, go back. Now, why would you do one versus the other? We'll probably let me start with a stock or an asset purchase. So a lot of folks, you will hear a lot of times like, hey, you should always do an asset purchase. As the buyer, it protects you the most from liabilities. So what people mean by that is they mean like, hey, if you're looking at that old building, that old store, it's got all the stuff inside of it. You don't know how old that building is. I mean, maybe it's 100 years old or 50 years old. Maybe but you don't know if like the plumbing is like really bad, the wiring is old. Maybe it's not been kept up very well. There are things called hidden liability. I got a comment here. Can you move that other screen from the words? Let's see. What is that better? Can you see that better?
Yep.
Okay, great. Sorry. Yeah, I didn't realize the little Google Meet window was up. Okay, so let's do that. Okay, great. So if you, okay, hopefully that's better. So the old building will have what we'll call hidden liabilities, where if you take it over, you don't know exactly what you're getting when you look, behind the walls, what's behind the walls or underneath the floors. So in an asset purchase, that's kind of like you're looking at this company, and that company may have some hidden liabilities. Those things could be like maybe the company didn't pay its taxes properly a couple years ago, and you won't find out until you get audited, and then you pay or owe money to the IRS or to a state taxing authority. Or let's say somebody slipped and fell on the premises of the company, and they haven't yet come to the company and said, hey, you owe me money because I had broke my leg or whatever. But maybe they do after you buy the company. If you do a stock purchase, if you buy the entire store itself, if you buy the company itself, then you will be liable for all of those hidden liabilities because you're buying you're running the same company. If you do an asset purchase, that's different because you have now built a brand new building right next door. The plumbing, the flooring, everything is brand new. There's nothing wrong with the structure itself. You're just moving all of the movable stuff from the old building into the new building. So people like to do that because they're like, hey, I don't have any scary hidden liabilities when I do an asset purchase and set up my own new entity and move all of the stuff into it. So that's the main pro of an asset purchase. Another pro of an asset purchase is buyers generally get more favorable tax treatment. If you buy assets, let's say the company that you're buying, and we'll just to go with the analogy, let's say that there was a bunch of like equipment in the old building and you move it into the new building. Since you bought that equipment for $10,000 or whatever it is, that's establishes your tax basis in that equipment, and then over coming years you can depreciate the value of that asset on your taxes, and that will help you pay less in taxes. So you get some more favorable treatment when you do that. Whereas if you do a stock purchase and you just buy the whole old building and everything inside of it, you don't get that newer basis. You're stepping into the company, the old company, which has probably already depreciated all of its assets, and as the new owner of the old company, you don't get to continue doing that if they've already been fully depreciated. So those are the main reasons people will do an asset purchase. So why not, why doesn't every buyer do an asset purchase? Well, the main reason that people will choose to do a stock purchase is because sometimes in an asset purchase, there are assets of the old company that it's really difficult to move them into the new company. Let's say you had like a big piece of equipment in an old building that was like, it was like welded to the floor and connected to all these pipes and everything, and it was basically a part of the old building. And if you were to try to move it, it would be a huge hassle. You'd have to take it all apart, move it over. You may not put it back together correctly. In that instance, you may just be like, hey, I'll just buy the old building because it's got all this stuff attached to it that I really, really need. Now, in an M&A deal, what can those kinds of things be? The main thing that can be hard to move from an old company to a new company are contracts. So let's say I had a client who he was buying like an HVAC company, and he most of the business that he got was, or that the target company had, came from a warranty company that had home warranties for all these people. And then when people needed help on they contacted their warranty company for help with their HVAC systems, the warranty company sent those folks to this target company. So my client was looking at buying this target company, and he was like, hey, that like 90% of the revenue of the target comes from that referral, from referrals from that home warranty company. And they have an ongoing contract between the target and the home warranty company saying, we have this just reciprocal arrangement, and a lot of contracts will have what are called anti-assignment clauses in them that say, hey, target company and warranty company have entered into a contract together because we know each other, we trust each other, we're willing to do this. But warranty company says, hey, target company, if you ever like sell all of your assets to somebody else, that means that there's a new owner of the company. We don't want to be in business with that new owner, and we don't know them. We want to stay only in business with the target company. And so in that instance, that was like an immovable piece of the target company that was the most valuable part of the target company, that contract. And so my client was like, hey, I can't move that contract into a new entity. So he decided to do a stock purchase. That happens a lot when there are, say the target has contracts particularly with government entities. I had another client who was buying a specialty cleaning company, and this company did most of its contracts, most of its customers were government entities, like for defense, like defense installations or buildings that were owned by the Department of Defense. And so those government entities in particular put anti-assignment clauses in their contracts, and they say, hey, you can't move this contract into a new company. So he did a stock purchase in that deal as well. So stock purchase, going back to the building analogy, yeah, you have this building, this old building, and you're like, oh gosh, it's got that stuff in there that really can't be moved. I really just need to buy that old building itself and just continue running the company as it is. The approach of that, the upside of that is if you do a stock purchase and you buy that old building and everything inside of it, at closing date, the seller just hands you the key to that building. You walk in, you own the building, you own everything in it. You don't have to move anything. The building continues operating, customers keep coming in, deliveries keep being made to that exact same spot. It's very simple. There's no need to transfer anything. There's no need to move anything. And so, but we already kind of discussed the cons. There may be some hidden liabilities, maybe some, and you may not get the favorable tax treatment of being able to step up your basis in the assets, but that's in a lot of situations, it's worth it to take those risks. And you can mitigate your risks by having the seller and really disclose, making sure that you do really, really good due diligence on the company, and that the seller discloses everything that there is to know about the company to you. And so you can, kind of look behind the walls or get under the floorboards if you want, so to speak, to make sure that you are comfortable that the risk of hidden liabilities is low, or even if you know of some liabilities you may be taking on, that they're worth it based on the assets that you're purchasing. So that's kind of the difference between a stock purchase and an asset purchase. I need to know this upfront because this changes how I draft the purchase agreement. So, a stock purchase agreement, what you are buying is, if it's a corporation, if the target is a corporation, you're buying the stock of that corporation. And if the target is an LLC, you're buying the membership interests of the LLC, which is the same. Membership interests are to an LLC as stock is to a corporation. They're both the ownership interest in the company, the equity in the company, and that's what you're actually buying in a stock purchase. In an asset purchase, it will say things like, buyer is purchasing all or substantially all of the assets of the target company, and there will be a schedule attached to the purchase agreement that lists out all of the assets in really broad language. It's not like, we don't typically have it like listed like, oh, there's many pencils or this many, whatever, but it's like all assets, all invoice or all accounts receivable, all intellectual property. It's a very broad categorization when we have an asset purchase. But that's what I need to know to even start drafting the purchase agreement, is which one you're going to do. And I always am happy to talk to my clients at the very beginning, like, hey, which one are you doing? And if you haven't decided, we go through the options. And in fact, I just got a client today who he's not sure which one he wants to do. And I explained to him the difference. He's like, I think I want to do an asset purchase, but we're going to double check and make sure that there's no, particularly that there are no contracts that can't be assigned and would make it so we need to do a stock purchase. So that's kind of the overview of stock and asset purchase, which is a really big thing that you need to think about when you're looking at these deals. Okay, so number 2 and number 3, we're going to talk about kind of who are the parties to the agreement, and we'll go through these a little bit more quickly. So as the buyer in this deal, whoever's listening to this, all of you who are listening to this presentation, you're all actual human beings, living, breathing people. But either you yourself are going to be the buyer, or you're going to set up some kind of a business entity to be the buyer in your deal. And which one you choose kind of there's some different factors related to it. So if you as an individual, the only time that I would advise a person, if I, John Wiest, was looking to buy a company, the only time I would buy a company in my own name as John Wiest is if I were buying all of the stock or membership interests in the target. If I'm buying the stock of Acme Incorporated, I can buy all the stock, hold it in my own individual name if I want to. And the fact that the corporation exists provides me with a lot of protection from liability because it is a corporation. Anybody who had a claim against the corporation would sue the corporation. They wouldn't sue me personally. But that's the only time that I would recommend that you as an individual be the buyer in a deal, is if you're doing a stock purchase and you're buying all of the ownership interests in a corporation or an LLC. I would say the most common type of buyer that I see in a deal are LLCs. LLCs are business entities that were invented sometime in the 1980s, and they offer some unique protections they offer the owners, or what are called members of the LLC, protection from liability, so that, similar to same thing as a corporation. But LLCs are taxed differently than corporations. LLCs are what are called pass-through entities in the eyes, at least of the IRS. And so an LLC to the IRS doesn't even really exist. The LLC itself it exists, but it's not taxed in any way. The LLC itself does not pay any taxes. The LLC makes distributions to its members, and the members themselves then pay taxes on the distributions that they get from the LLC. So my law firm is an LLC. It does not itself pay any taxes to the IRS, but myself, John Wiest, as the member of the LLC, when I take distributions, pay myself from the LLC, then I pay the IRS on what I've earned. Corporations are different. Corporations have been around for hundreds and hundreds of years. And as far as they also offer, a corporation is set up and its owners are called stockholders. They own shares of stock in the company, and it offers them liability protection if something happens on the, build, or if there's a slip and fall in the building that is owned by the corporation, the person who was injured sues the corporation, doesn't sue the shareholders. But there are two main types of corporations for tax purposes. One is just the regular old C corporation. This is the default type of corporation, and the C corps get taxed twice. So the corporation itself, Acme Incorporated, pays taxes on all of the money that it earns, and it's its earnings, its revenue, or whatever it is. And then the corporation makes distributions to its shareholders, and then its shareholders also pay taxes on what they get from the corporation. So there's double taxation there, which is not ideal. There's a different kind of corporation that a corporation can make an election or file a form with the IRS saying, hey, we don't want to be a C Corp, we want to be an S Corp. And an S Corp is taxed similarly to an LLC, where the corporation itself does not pay any taxes, but its shareholders pay taxes on what they get from the corporation. So that's great. It's only a single level of taxation, and you get a corporation. That's wonderful. But there's some restrictions on who can be shareholders of an S Corp. So a regular C Corp, anyone can be a shareholder of a C Corp, an individual, another corporation, an LLC, a trust. They all can own shares of a corporation. But S Corps are different. They are and also you can have almost an infinite number of shareholders in a C Corp. I mean, hundreds, millions of people own shares in these big public companies. S Corps there's a lot more restrictions on who can be a shareholder of an S Corp. And it's really limited to actual individual human beings and single member LLCs. So like an LLC that only has one member. If an LLC has two members, cannot be a shareholder of a S corporation. And there are some trusts that can be members of S corporations. So if you, let me think just one second. So you really need to think carefully about what you want in the future. So if you're looking to buy a company, you're like, hey, I'm just going to buy this company. I'm going to own it myself, or maybe I'm going to own it with like my spouse or something like that. We're not looking to sell to hundreds. Oh, and the other thing of the S Corp is that it's limited to 100 shareholders. So you're like, hey, I'm not looking to go into business with hundreds of people. I'm not looking to do a public offering where I take my company public. Just want to run this company for some period of time, maybe sell it in the future. Then you can do an S Corp. If you have ideas where you're like, no, I want to bring in like a venture capital firm or a private equity firm or something to be a partner, to buy part of my company in the future, you probably would not want to do an S Corp. You'd want to do a C Corp because those future partners may not qualify as shareholders of an S Corp. And so then you got to think about those things when you go up front. Now, as far as an LLC, the difference, LLCs and corporations both offer you the liability protection that I talked about. One of the main differences between them, besides the tax stuff that we just talked about, is that it's very easy to sell shares of a corporation to other people. So again, if you're looking to sell to other people in the future, bring in investors, it's pretty easy to do that if you have a corporation. It's much harder. It's much harder to sell ownership interests in an LLC to other people. It's certainly possible. People do it all the time, but it's you usually have to get permission from all of the members. So if you started an LLC with you and a friend, and you guys are partners in the LLC, and then in 2 years you're like, hey, I want to bring in somebody else to be an owner. You and your partner both have to agree to that, and you can't just like go out and sell it to just anybody. You have to. It's just harder to sell membership interest in an LLC. Now, on the flip side, that may be what you want. You may want to closely hold your company, and you don't want anybody else to be able to just come in and buy. So like if you are starting your LLC with your friend and you're like, hey, I know my friend, I know my partner, we want to be in business together. But you're like, I only want to work with people that I know really well, that I trust that I trust a lot. Then if you start an LLC, then you know that your friend can't just go out and sell their ownership interest in your LLC to anybody else, to some person you don't know and don't want to be in business with. So again, kind of a lot of like things to think about and which one you're doing. For most of the clients that I've worked with, especially ones who come from acquire and looking at deals in like the small mid-sized space, most of the time the buyer is the LLC. But I'm happy to discuss that with anybody when we're looking at their deal. So I kind of just threw a lot at you about different kinds of business entities. So similar question about who is the seller. This just relates same kind of considerations I just talked about with the buyer. If the seller is, if you're doing a stock purchase, it's likely that the seller, so you say you're buying all the stock in Acme Incorporated, the stock is probably already currently owned by an individual or maybe a trust, but Jane Doe owns all of the shares in Acme Incorporated. She's selling them to you. You can buy them as an individual or as like an LLC or corporation. Whereas in an asset purchase, it's a little bit different where rather than Jane Doe being the seller, the target itself is the seller. So if you're buying all of the assets of Acme Incorporated is the seller in the purchase agreement listed as the seller, and your buyer is the whatever entity you've set up to take all of the assets. One major consideration that comes up in a lot of deals is if you want the favorable tax treatment of an S corp, and one thing I should have mentioned just a minute ago, LLCs are typically, I said that their taxes pass through entities, which is true, and they're by default they're taxed as partnerships, and you can elect to have your LLC taxed as an S corporation, which allows you to and again, talk to a CPA more about this, but an S corporation can pay wages to its owners rather than making purely distributions, and the company itself can pay like your taxes, your like employment taxes, things like that. So a lot of folks, in fact, my LLC is taxed as an S corp, and I'm technically a W-2 employee of my LLC. So LLCs can be taxed as S corps. Actual corporations can be taxed as S corps. If you want to maintain that S corp status, if you're doing a stock purchase and you're actually buying the, Acme Incorporated, it's currently taxed as an S corp, and you want to maintain that S corp election, then you have to make sure that the buyer is a proper shareholder, meets the qualifications for a shareholder of an S corp, which would mean it has to be either an individual or a single member LLC. I've had a number of deals where my clients have been looking to buy a company that's they're doing a stock purchase of the target is taxed as an S corp, and say my clients is a husband and wife or a spouse, two people who are spouses, and they want to maintain the S corp election. I tell them you guys cannot own an LLC that you two are the members of that buys the target, because then the owner of the target would be some entity that was not a single member LLC or an individual, so they have to buy the stock or the membership interests in their own names. So again, kind of a lot to think about in that, and happy to talk in more detail with any of you about that when we get to that point. Okay, so let's talk, and I'm moving a little bit more quickly through these middle ones because I want to spend some time talking about net working capital. So chances are that unless your target company is like an e-commerce company or something like that, you may have, the chances are that the target operates out of a physical space. Maybe they lease some property, maybe they own a property. If it's like some kind of a company that needs warehouse space, they may own a warehouse, they may lease it. But we really need to know that and what you want to do with that real property. So if the target, so say you have Acme Incorporated and let's say it's just a manufacturing company and it operates out of a warehouse space with like an office attached, an office in front and a warehouse in the back. And there's a yard where they keep their trucks or something like that. It's possible that Acme Incorporated, say the owner, Jane Doe, owns it. She may also own an separate LLC that owns the real property where Acme works. So Acme Incorporated is the running business, and then Acme LLC is, or like let's call it Acme Holding or Acme Real Estate Holding LLC, probably owns the land itself in a different business entity. That's very common. I see that when the same kind of the principal of the target, the principal owner of the target, owns both the company itself and the land and the buildings where it operates. So in those situations, I've had clients who have been like, hey, we really want to buy the building ourselves and we have the money to do that. And so sometimes I will always advise them to set up two different entities, one to buy the business and one to buy the land. And the two transactions can happen at the same time. They can close at the same time. There will be two separate purchase agreements. because real estate transactions are different than other kinds of transactions. I've done both. It's not a huge deal, but there are just a few more hoops that you have to jump through. I would say more commonly, folks either they're like, hey, I don't actually want to buy the real property, and so they are like, I'll just continue to lease it. And so maybe the target principal, the owner of the target company, maybe they own the real property, or maybe they're like, hey, I don't own this warehouse. I just lease it from this landlord that I've leased it for the last 20 years. And in either case, you will want to enter into you'll either take over the existing lease for the property, or you'll enter into a new one with the landlord. And if you're doing a stock purchase, you're just buying the whole thing, and then the whole building. Well, that analogy doesn't work here because I'm talking about a lease. But if you're doing a stock purchase and you're just buying the old company itself, you can probably just take over, or the lease is still operating between the old company, the target company, and the landlord. But you will need to notify the landlord, hey, I'm the new owner of the company. You can't just kind of like sneak in there and not tell the landlord. They're going to find out about it. And almost all leases have a provision. It's relatively easy to assign leases, but even if you can't assign it, it will probably have a change of control clause that says, hey, if the company gets new owners, you have to tell me, the landlord, about it. And most landlords, they don't really care as long as they keep getting their rent. But if you are doing an asset purchase, and you're moving all the stuff, including the lease, into a new business entity, the lease may not be assignable to the new company. That's not the end of the world. You just have to enter into a new lease with the landlord. And I often think it's a good idea to get a new lease anyway, because then you're not liable for something that the old company did under its old lease with the old landlord, or with the landlord. The downside of getting a new lease is that the landlord may look at it as an opportunity to like jack up the rent, to do all these things like, hey, you have to give me a huge deposit that maybe the old company didn't have to give. I had one deal last year that really, I'd never seen this before, but the landlord in this deal was so incredibly unreasonable. he was basically extorting the parties, where he was saying, oh, the old company, the seller, he has to do all these repairs on this warehouse space that he's been in for 35 years. And it's going to be tens of thousands of dollars, and he has to pay all that to me before I'll release him from the old lease and enter into a new lease with the buyer. And this landlord, it was a crazy situation. I've never seen anything like it. So this is really like a horror story. I don't see this. I've done dozens of deals. This almost never comes up, but that is one thing that you need to look at. Is like maybe the landlord will be very unreasonable and try and screw you in a new lease, basically. So those are kind of the different options for real property. And you may not know right at the beginning which of these you want to do, and that's totally fine. We can talk through it. The vast majority of landlords, like I say, they don't care who rents. To a certain extent, they don't care who rents their property, as long as they get a lease in place and they get paid every month. So we can talk in further detail about that. Okay. Question number 5 is, I'm going to ask you about your financing. So every once in a while, sometimes I have a buyer come to me and they're like, hey, I'm buying a company and I'm just paying cash for it. In fact, just got one last week where it's a smaller deal, and the buyers are a group of 4 people, and they have enough cash between them to just buy the company outright, and they're paying. And that's great. So they don't need to have a bank involved in their deal. But it's much more common for the buyer to be getting a loan to finance the purchase of the company. So it's typically a combination of bank, seller, and buyer financing. So the buyer is probably putting some amount up front as a down payment or deposit to the bank, and then the bank is floating 80 or 90% of the purchase price that they're giving as a loan to the buyer. And then the seller, and this is pretty much a requirement when you're getting an SBA loan, the seller will often be asked to finance some part of the purchase price, usually 10%. So that most of the deals that I do in the small and mid-sized space, they are SBA funded by SBA loans, and this is the mix of financing that we see. And so seller note. So I, as part of my job in drafting the purchase agreement, is that I'll draft the seller, the note from the buyer to the seller. So the seller has agreed to finance 10% of the purchase price. They're going to get paid typically like over 10 years. This is just, and the interest rate is kind of a typical interest rate for a business loan at this point in time. One thing I will, and then that's totally fine with the buyer. A lot of times the seller and the buyer will agree that interest will accrue on the seller note from the beginning of the loan, but the buyer will not be required to actually make any payments on that note until 2 years have passed, or maybe 3 years. 2 years is very typical in what I see. And that's great. That gives the buyer some breathing space, a couple of years when they, after they buy the company, to kind of get their feet into them before they have to start making payments to the seller. Now, you're already, if you have a bank loan, you're going to be making payments to the bank immediately. But your extra payment to the seller doesn't usually kick in until, or sometimes does not kick in for a couple of years. One thing that I will kind of preface for everybody is a lot of times in an LOI, it will just say that the seller is, financing 10% of the purchase price. And it doesn't say anything about whether or not that loan from the seller to the buyer is secured. And what I mean by secured, and if you already know this, just forgive me for explaining it, but is that usually when somebody lends money to somebody else, the lender takes some kind of collateral, gets some kind of a security for the loan, so that in case the borrower stops paying, the lender has some kind of recovery. Like if you bought a house, every mortgage you get, it says what a mortgage is the bank saying, hey, I'm giving you money to buy your house. If you stop paying the loan, then we get to take your house and sell it to repay the loan. So I have been frankly astounded at how many sellers will agree to give a promissory note to the borrower, and they don't require any security. I think that is a very stupid thing to do, for anybody to give a loan without requiring collateral or a personal guarantee. And a personal guarantee, really quickly, is where, if I'm lending to Acme Incorporated, and Acme Incorporated is the one that's supposed to pay me, $10,000 a month or whatever, a personal guarantee means that Jane Doe, the owner of Acme Incorporated, she signs a document saying, hey, if Acme Incorporated stops paying you, I will immediately step into the breach and pay you on behalf of Acme Incorporated. That's a personal guarantee. So most of the time, and every bank will require both collateral saying, hey, if you stop paying, we can foreclose on your assets, and a personal guarantee from the person who owns the business, that's the borrower. So I think it's crazy that these sellers give these unsecured loans, but as the buyer's attorney, it's not my job to tell the seller, hey, you should get security for your loan. So when I draft these notes, I always draft it as unsecured. I don't say anything about security interest. I don't say anything about personal guarantee. I tell my client, if they come back to us and want one of these, we should give it to them. It's totally reasonable. It's a market standard. But if they're ignorant enough, and their attorney is ignorant enough to not require it, then that's great for the buyer. So just kind of flagging that for you guys, something that I see, and it really astounds me, quite honestly, but I'm not going to, I'm not going to offer it to them in the first instance if they don't request it. If they come back and request it, I think it's proper to give it to them. But that's just kind of something that I see that's interesting to me. Okay, so let's talk for the last few minutes about net working capital. So what net working capital is, and I will say that this is by far the most complicated and most heavily negotiated part of any deal. So as a business owner, you have to have some amount of cash to run your business. And I just want to make sure I don't have any notes here or comments that people have brought up. Okay. So you need cash to run your company. You need cash flow. You have to make payroll. You have to pay for supplies, et cetera, et cetera. And so when you, as the new owner, step in to the company, you own the company on day one, you need some kind of cash to run the company until you start collecting like accounts receivable, so you start making sales and getting cash flow from your customers. So it's very typical for the seller to leave some kind of cash or cash equivalent behind with the company to help the new owner run the company post-closing. And why would a seller do this? Because they usually have a note from the buyer, and if they want to get paid on that note, then the buyer needs to keep operating, needs to be a successful business. So the seller is incentivized, if they're going to get paid on their 10% loan to the company, they need to make sure they want to do everything they can to make sure that the company is successful after they sell it. So net working capital comes in a variety of forms. One is just straight up cash in a bank account. Another form is accounts receivable, which are almost like cash. If the company has a bunch of accounts receivable, it's provided services and it's invoices clients, but they're 30 days payment and they haven't yet collected them. Excuse me. Accounts receivable is almost as good as cash. That's payment that the company is owed. You just have to go out and collect it. And so sometimes people will do, and if the seller leaves accounts receivable, they'll often also leave accounts payable. So, have a bunch of $100,000 in AR and $50,000 in AP that we have to pay to our vendors or to our, or to make payroll or pay our employees and things like that. And so cash or net working capital can be defined as AR minus AP. That's also very common. Or it can be a mix of like a portion of the net working capital is going to be in the form of cash, a portion of it's going to be in the form of AR less AP. So this can be negotiated either before or after the LOI. It's more commonly negotiated after the LOI. The LOI will typically say things like, the company will have, at closing, will have a certain amount of net working capital to be determined between the parties as they negotiate the definitive agreement or something like that. So you, as the buyer, you need to figure out where you're going to get this net working capital. There are kind of two ways I have here on the slide. And one is that the seller leaves or transfers some net working capital as part of the deal. So this is some sellers have a really hard time with this. Like psychologically, it's difficult for them to think, hey, I'm selling this company. I'm supposed to get paid a whole bunch of money at closing. Why? And now the buyer is asking me to give them $100,000 in cash or whatever amount in cash. Like, I'm just not supposed to, like, why am I the seller giving money to the buyer? The buyer is supposed to be giving money to me. That's sometimes really hard for them to come to grips with. Other sellers are like, yeah, I get it. You need some cash from the company post-closing. And they really don't have, and it's, it's really incorporated into the purchase price. If they're leaving you $100,000 in net working capital, then they're just going to increase the purchase price by $100,000. So they're not really out anything. And if they don't understand that, hopefully their attorney can help them understand that, but that doesn't always work. And so that can be complicated, and arriving at the amount of net working capital that you need or that is acceptable to the parties can be really kind of complicated. As a general rule of thumb, and I will preface this by saying helping you calculate the net working capital amount is not that's typically what I do. That's something that you need to work on with your financial advisors, because you really need to look at how the company has been operating and see, hey, it's had a certain amount. This is how much cash the company has needed to run like on a monthly basis over the past couple of years. And then so you're like, okay, so it stands to reason that in the first couple months after closing, we're going to need that similar amount of cash. That's kind of the way that people tend to calculate it. But again, this is something for financial people, CPAs, to help you with. And so you can get net working capital from the seller, and it's part of the purchase, or it's part of the purchase agreement. It says, we'll talk about how much net working capital the company should have at closing. And there's often kind of a complicated mechanism in there for calculating, because the seller may say, oh, we will leave you $100,000. I'm just choosing round numbers here. $100,000 in net working capital at closing. And they tell you that like 2 months before closing. But let's say that their account, cash flow in and out is kind of volatile. And so they don't actually know and cannot really guarantee that on the closing date, 2 months later, that they're going to have that exact amount of money. So maybe closing date comes and they actually only have $95,000. There's usually a mechanism in the purchase agreement that deals with what happens if the target number that you guys set like a month or two before closing isn't actually what's there on closing. Maybe you bring the purchase price down by the same amount. And that's all I'm going to say about it at this point, because it's a really complicated section of the purchase agreement. But that's kind of roughly how we deal with that. The other way to get networking capital is to get a line of credit from your bank. This is simpler in my opinion. It's, you may not want to do it because the then you have to pay it back to the bank, and you're being charged interest. And there are different considerations that go into it, but sometimes it's just, and it really depends also on the type of business that you're buying. But that's also one option. And if the bank is willing to give you some amount of cash as a line of credit to help you operate post-closing. But networking capital is definitely something that, like I say, it's the most complicated and most heavily negotiated part of any deal, if it is negotiated. Sometimes people come to me and they're like, no networking capital whatsoever, and the deal is much simpler. But if it is a component of the deal, it can be really hard to calculate. And there's just kind of a lot of mechanisms, or kind of a lot of practical things that we need to figure out. Totally doable. Do it all the time. I'm not just trying to scare you or anything like that, or act like it's impossible. I'm just saying that it's something that you should start addressing sooner rather than later, because it can really delay if you aren't able to come to an agreement with the seller. It can really delay closing. I had a deal that closed just last week, and the closing was delayed by about a month because the parties were having a really hard time landing on how they were going to handle networking capital. So it's definitely something that I recommend that you start talking about with all of your advisors and with the seller very early. So I have, let's see, a few minutes here for questions. Happy to answer any questions that any of you have if you want to ask them here. In fact, let's see. I'm going to stop sharing my screen so that I can more easily see if there are any questions. Let's see if I can figure out how to do that. Stop sharing. Happy to answer any questions here. I'm also available happy to chat on the phone, hop on the call for 15 minutes, kind of talk about if you have any questions. And Andy, I believe you sent out my contact information. Folks, please feel free to email me, call me, and answer any questions. So I don't think I see any questions unless I've missed some. Let's see.
I'll just send your contact information in the chat so at least they can.
Yeah, I know I threw a lot at you guys, and hopefully it was helpful. And this is really all I do in my practice, and so happy to answer any questions and help in any way that I can.
Well, thank you so much, John, for this wonderful session, and I really appreciate the people who attended. Great. And if you do have any questions to John, feel free to email him or maybe call him. And yeah, let me know if you do have any concern that we can reach out to John as well. Thanks, everyone.
Thanks, everyone. Have a great Monday.